I've been talking a lot about individual ETFs and the specific benefits they provide, whether it's maximizing growth, maximizing dividend income, or minimizing downside risk. But of course, no portfolio is going to be made up of one ETF. There's going to be combinations of different ETFs together that complement one another. Now, given current market trends, there's a very powerful 2 ETF combination that I think can provide investors with not only an amazing source of growth, but also provide exceptional risk mitigating capabilities accompanied with very strong monthly income. And the most important thing to note here is that this combination could be very powerful moving into 2026 specifically. I want to make that very clear. But there's also a very interesting twist here that I think makes this combination even stronger. And I will be explaining my reasoning behind these 2 choices in detail, so this is where things get really interesting. If you guys are enjoying this content and find it helpful, please do me a little favor and hit that thumbs up button for the YouTube algorithm. It really helps out my channel and I really appreciate it. So thank you guys so much. Let's move on. Now, the typical growth and value combination is what many investors base their portfolios on, and it still applies here. But right now, value and dividend ETFs are amongst the best performers in the markets, and that is primarily based on 2 key reasons. For one, volatility is starting to pick up, and investors tend to seek dividend assets during times of uncertainty because they naturally exhibit less volatility, serving as a very effective hedge. Remember, companies that distribute dividends tend to exhibit strong free cash flow, financial stability, and low debt levels, which is why they provide stability during uncertain times. And secondly, with more interest rate cuts coming this year and in 2026, although the trajectory is rather uncertain, fixed income assets, treasuries, and money markets will provide less and less income as their yields fall in line with interest rate cuts. As a result, income investors will naturally shift to dividend assets in order to achieve their desired income. Now, I want you to remember these 2 reasons as we move throughout the video. So the first ETF in this combination is SCHD, which is the Schwab US Dividend Equity ETF. This ETF is probably one of the most common holdings amongst all dividend investors, and there are 2 key reasons I wanted to use SCHD in this combination. For one, it is extremely popular. I also recently made a video on Devo and I share my thoughts on why it could replace SCHD, and it definitely can, I want to make that clear, but for the purpose of this video, I'm sticking to the more popular choice. But towards the end of the video, I will briefly touch on the one benefit that Devo can provide in this portfolio combination. Now, the most important reason behind my decision is that the stock picking criteria of SCHD works very well in today's economic environment. SCHD uses dividend history, dividend growth, free cash flow, return on equity, and dividend yield as its primary stock picking criteria. As we discussed, companies that distribute dividends tend to have strong free cash flow and low levels of debt. And right now, during times of uncertainty, this is what investors favor. The ETF also screens for strong dividend growth, which is another characteristic that gives us insight into a company's financial health and cash flow stability, which further caters to what investors seek during times of uncertainty. Now, the ETF also uses a final screening criteria called IAD yield. And I've talked about this before, but all this means is that it screens for companies with the highest dividend yield after it has gone through all the previous steps. For regular viewers of my channel, you know that I have criticized this criteria, which is why I wasn't a big fan of SCHD through majority of 2023 and 2024. Many powerful companies that exhibited strong cash flow, strong return on equity, and strong dividend growth were disregarded from the ETF just because their dividend yield wasn't high enough, and therefore limiting the ETF's total returns. That is why SCHD underperformed its peers like DGRO during majority of 2023 and 2024. However, right now, given that more rate cuts are coming, this attribute will likely work in favor of SCHD moving into 2026. Like I said, investors will seek dividend assets to replace fixed income assets as their primary source of income. And SCHD is amongst the only passive dividend ETFs with a dividend yield that is over 3.5%. So now you have 5 criteria that will work in favor for the ETF moving forward. Okay, so moving on to the second ETF, and this is where I want you guys to pay very close attention. In order to find a strong pair for SCHD, I focused on a few key factors. For one, I wanted something that did not overlap with SCHD, because ETFs that have similar holdings defeat the whole purpose of diversification. And to figure this out, you can use free websites like ETF Research Center and their fund overlap tool, and under 30% is the rule of thumb. Now, because SCHD is more value-oriented, it will hold less growth stocks, which means that a complementary ETF will have to be a tech-focused ETF. But I had a few problems with this. For one, technology stocks are heavily overvalued right now, so exposing yourself to these tech-focused ETFs like the QQQ or even SPY without any sort of buffer seemed risky to me. So I wanted to minimize this risk as much as possible. Now, the AI momentum is still pushing these ETFs to new highs, but there are a few major risks here such as overvaluation, high volatility, which could persist for a while. Now, if you remember, high volatility is favorable for one specific asset, and those are high income ETFs. These ETFs use option strategies such as covered calls on their underlying holdings in order to generate exceptionally high dividend yields. And these dividend yields serve two purposes. First, they minimize the overall volatility by cushioning the downside with income. And secondly, the regular income can be used to dollar cost average. Plus, high volatility favors option strategies because of a relation called vega, which causes the premium income on call options to increase with volatility, boosting the overall returns. And an ETF that embodies strong income generation and exposure to tech stocks without taking on 100% of the volatility is JEPQ, which is the JP Morgan Nasdaq Equity Premium Income ETF. SCHD and JEPQ could be a very powerful combination moving forward. Plus, there's a very interesting strategy investors can use here, so this is why I want you guys to pay close attention. To begin, JEPQ and SCHD have very little overlap, providing strong diversification. However, JEPQ's strategy provides a very specific advantage. JEPQ uses a covered call strategy on the Nasdaq 100, and it uses approximately 20% of its assets to sell out of the money call options while leaving the other 80% exposed to stocks. But contrary to what many people think, JEPQ's underlying holdings are not exactly the same as the QQQ. The ETF actually uses an extra screening step, giving it slightly better downside risk mitigation. And you can clearly see it here on specific days where JEPQ captures only 50% of the downside of the QQQ. And this is not including dividend income. Also remember, the ETF is using around 20% of its assets to sell call options. So that means that only 80% of its assets are exposed to the markets, which naturally already minimizes risk. And here's where things get even better. In a sideways trending market, JEPQ will outperform the QQQ because the covered call strategy will generate extra returns, giving it superior total returns. And we did catch a glimpse of this in the beginning of 2024, where JEPQ was outperforming the QQQ by around 3%. So not only will JEPQ minimize the downside risk of the QQQ, but it will also outperform in a sideways trending market. Now, the best part about JEPQ is the dividend yield, which is around 10% and is distributed on a monthly basis. And if you combine that with the income you would receive from SCHD, which is around 3.5%, the total income of your portfolio in a 50-50 split allocation between the two ETFs would be roughly 7%, which is very good. I mean, when you compare total income of an SCHD and QQQ combination with an SCHD and JEPQ combination, it is not even close. And the best part about this extra income is that it gives investors the flexibility to reinvest the dividends not only into JEPQ but into SCHD as well. You see, if big tech does suffer more, investors that are just holding QQQ would have to ride out the wave and hope that SCHD's returns would cushion that. But with JEPQ, not only will you suffer less in terms of price depreciation, but investors can take the dividend income and reinvest it into SCHD, giving SCHD a stronger boost and enhance overall portfolio returns. So naturally, the balance between these two ETFs would shift more in favor of SCHD when it's necessary, therefore giving your portfolio superior total returns. And the same thing applies if the AI momentum continues to push tech stocks higher. Investors could reinvest JEPQ's dividends back into JEPQ, but also take SCHD's dividends and put it into JEPQ, slightly shifting the allocation more in favor of growth. So there's a lot of flexibility here with these two ETFs, and that is why I find that a combination of SCHD and JEPQ could be very powerful moving forward. You're covering so much ground in terms of risk mitigation, growth, and income generation. Now, this isn't the only combination. For those that want more exposure to growth, a perfect replacement for SCHD would be DGRO or CGDV, and I have been a very big fan of both of these for a long while. DGRO has a stronger tech allocation and mainly screens for dividend growth, but that is also why DGRO overlaps more with JEPQ. And CGDV is actively managed, is performing phenomenally, and is one of my favorites overall. but I'll talk more about that in another video. And like I mentioned earlier, another alternative could be Devo. And the one major benefit I find with Devo over SCHD is that Devo's dividend yield is not only more than SCHD, but it also distributes it on a monthly basis as opposed to a quarterly basis. And that whole talk about reinvesting dividends could be even more powerful when both of the ETFs are distributing dividends on a monthly basis. Plus, with the DIVO and JEPQ combination, the average dividend yield of your portfolio would be around 8%, which could be much more favorable for income investors and retirees. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit the thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.